you're going to see something that feels completely backwards. Silver can spike higher in a single day. Headlines start screaming shortage, social media starts buzzing, and silver miner stocks barely move or they even drop. If you've ever stared at that and thought, this can't be normal, it feels like miners are being held down on purpose. You're not crazy for thinking it. Because when you look at how the system is built, there are real, repeatable reasons miners get suppressed right when you'd expect them to fly. Before we get into it, if you want more simple story-style breakdowns like this, please hit like and subscribe. It takes 1 second, and it helps this video reach more people who are trying to understand what's happening behind the scenes in markets, not just what the headline says. Now let me start with a quick scene that might sound familiar. You wake up, check silver, and it's up strong. You feel that rush for a moment because you assume, okay, miners are leveraged to silver, so they should be up even more. Then you check your favorite silver miner, and it's flat, or worse, it's down. You refresh the page. You check another miner. Same story. And that's when the doubt creeps in. You start wondering if the entire silver mining space is rigged, ignored, or targeted. Here's the uncomfortable truth. Silver miners don't trade like silver times 2. They trade like businesses trapped inside a financial machine. And that machine has incentives that often work against miners, especially smaller ones, especially during volatile moves, and especially when the broader market is nervous. So when I say it's on purpose, I'm not saying there is one single villain sitting in a dark room flipping a switch. I'm saying the incentives are designed in a way that repeatedly produces the same outcome. When multiple powerful groups benefit from low and stable silver prices, the system naturally leans toward pressure that keeps silver, and anything tied to silver from getting too hot too fast. And miners live at the center of that pressure. Let's break it down in a way that actually makes sense. First, silver miners are not pure silver exposure. They're operating companies with risks that have nothing to do with the metal price. They have labor costs, diesel costs, electricity equipment, environmental rules, taxes, royalty payments, permitting delays, and political risk. In the US market, miner stocks trade alongside tech stocks, banks, and everything else, which means miners get hit by broad risk-off selling, even when silver is doing fine. So sometimes miners aren't suppressed. They're simply being treated like risky equities in a market that suddenly hates risk. But that's only the surface layer. The deeper layer is where things start to feel intentional. Because in a world where silver is both a monetary metal and an industrial input, a rising silver price is not good news for everyone. Think about who needs silver to stay cheap. Industrial buyers like electronics and solar supply chains want predictable input costs. Governments and central planners want calm signals in the monetary metals, because exploding metals prices can look like a vote of no confidence in currency. And major financial players, who built huge paper markets around metals, benefit from stability, because stability keeps confidence in paper settlement. So even if nobody says it out loud, there's a quiet, constant incentive to prevent silver from turning into a runaway headline. And when silver is prevented from running, the businesses that depend on higher silver prices for bigger margins get squeezed. That squeeze is real, and miners feel it first. Now here's something most people miss. Even when silver rises, it doesn't automatically mean miners become wildly profitable overnight. A miner's profit is not the silver price. It's the silver price minus all-in sustaining costs, minus capital spending, minus royalties, minus financing costs. If costs are rising at the same time silver rises, the benefit gets muted. And in the last few years, mining costs have been brutal. Energy, labor, parts, regulation, insurance, financing, everything got more expensive. So the market often says, show me the profit, not the hype. That's one reason miners lag. But the part that really makes miners look suppressed is what happens in the market structure itself. Silver miners are a favorite playground for short sellers and hedge funds because many of them are small, thinly traded, and easy to push around. If you have a stock with low daily volume, you don't need a massive amount of money to control the tone of the chart. You can lean on it, you can cap rallies, you can shake out weak hands, and you can keep sentiment depressed. That doesn't require a conspiracy. It requires math, liquidity, and patience. And when a stock is heavily shorted, there's a psychological effect too. It creates a ceiling of doubt. Every rally gets sold into. Every breakout fails. And the average investor starts thinking, maybe this company is broken. Even when the fundamentals are improving, the chart trains people to stop believing. Now let's connect this to the silver price mechanism itself, because miner suppression often starts with price suppression. The global spot price most people see is heavily influenced by futures and paper trading. Paper markets are not automatically fake, but they can create a world where supply looks infinite because contracts can be created instantly. Physical silver cannot be created instantly. It has to be mined, refined, shipped, and delivered. So you end up with two realities, the fast paper reality and the slow physical reality. When physical demand spikes, like when silver trades higher in Shanghai than in Western markets, That's a signal that real metal is being pulled. But paper prices can lag because paper markets can absorb demand in the form of contracts rather than bars. And if paper prices lag, miners suffer because the price they ultimately sell against is still anchored to that paper reference. So miners can be producing real metal into a system that prices their product with paper first. That is a structural suppression mechanism. Again, not a cartoon villain, a structure. Now let's talk about why this hits miners so hard. Imagine you're running a silver mine. You can't just hold inventory the way some investors can. You have payroll, you have contracts, you have ongoing costs. You need cash flow. If the market keeps silver contained, miners can't fully benefit from tightening physical conditions. That's when you see mine shutdowns, delayed projects, reduced exploration, and less future supply. Ironically, that sets the stage for bigger moves later, but miners often get destroyed in the waiting period. Another on-purpose pressure point is financing. A lot of silver miners, especially juniors, survive through raising capital. And when their stock price is suppressed, they have to raise money at worse terms. That means more dilution. More dilution means shareholders get less upside even if silver rises later. And when investors see constant dilution, they stop buying. That keeps prices low. It becomes a loop. Low price forces dilution. Dilution creates selling pressure. Selling pressure keeps price low. Who benefits from that loop? Anyone who can provide financing at those depressed levels. Anyone who can pick up assets cheap. Anyone who can acquire a project before it becomes valuable. Suppression creates bargains, and bargains attract predators. Now let's go one layer deeper, because this is the part that's rarely explained clearly. Even if silver is bullish long-term, miners can get suppressed in the short term because big money trades miners as a pair trade. That means they'll go long one thing and short another to neutralize risk. For example, a fund might be long gold, short silver miners, or long a major producer, short a basket of juniors. Or long the metal, short the miners to capture relative value. These are not emotional trades, they are mechanical. And mechanical trades can crush sentiment because they don't care about your narrative. They care about spreads, volatility, and liquidity. Then there's the index effect. A lot of money flows through ETFs and indexes. When an index rebalances, it can force selling even if nothing is wrong. When money leaves a sector ETF, it forces selling across the underlying stocks. The miner doesn't have to do anything bad, it just gets sold because of structure. This is one reason miner charts can look like they being leaned on by an invisible hand. Sometimes that invisible hand is simply passive flows. Now, let's connect this to tomorrow, because your title says, watch tomorrow, and I want you to feel like you have a real checklist in your head without me dumping a boring list on you. The first thing to watch is whether silver itself makes a clean move and holds it. Silver squeezes, and silver breakouts don't usually fail slowly. They fail fast, or they explode. If silver pushes into a major level and then gets slammed down quickly, miners usually get hit even harder because the market hates false breakouts. Traders lose trust, and they exit miner positions first. The second thing to watch is the relationship between silver and miners. If silver is green and miners are red, that divergence is information. It often means the equity market is pricing in risk, dilution fears, or disbelief in the move. If silver is green and miners suddenly start catching up with strong volume, that can mean the market is starting to believe the move is real. The third thing to watch is physical signals that paper can't ignore forever. If Shanghai keeps paying more for silver, if premiums stay high, if physical supply looks sticky, then the paper containment story gets harder to maintain. You don't need to become a data scientist. Just watch whether that gap in physical tightness lasts more than a few days. Persistence is what turns a signal into pressure. The fourth thing to watch is stress in the future structure, especially near-term urgency. When the market starts valuing silver now more than silver later, that's when paper systems can feel strain. That's when price moves can turn sudden. And when price moves turn sudden, miners can snap higher after months of being ignored because the market suddenly reprices future cash flows all at once. Now let's address the emotional part, because miner suppression is not just numbers. It's psychological warfare. Miners are famous for disappointing people. They dilute, they miss timelines, they face political issues, they have accidents, they hedge at the wrong time, they get shorted, they break investors' hearts. And because that history is real, the market assigns miners a trust discount. Even when silver rises, the market says, prove it. That discount is a huge part of the suppression story, and here's why that matters for retention in your own thinking. If you only watch price, you'll get frustrated. But if you watch positioning, flows, cost pressures, and physical signals, you start to see the bigger movie. And the bigger movie is this. Silver miners often get suppressed in the quiet phase so they can be repriced violently in the loud phase. That's exactly why the moves, when they come, can feel unfair. The miner you held through months of boredom might jump 20% in a week when everyone finally notices. And the reason is simple. Markets don't reward patience steadily. They punish patience. And then they pay, suddenly. Now, I want to be responsible here. Not every miner is a victim. Some miners are genuinely poorly run. Some are promotional. Some will never produce. Some exist mainly to raise capital. So part of what looks like suppression is the market correctly refusing to reward bad businesses. That's why separating quality miners from hype miners matters. But even high-quality miners can be suppressed when the system wants calm. Because when silver miners start running, they broadcast a message. They broadcast leverage to silver. They attract attention. And attention is exactly what some players done want when they were trying to keep metals from becoming a headline. So if you're sitting there thinking, okay, but is it really on purpose? Here's the clearest way to answer it. When a system repeatedly produces the same outcome, the system is working as designed for someone. Maybe not for you, maybe not for miners, but for someone. Low prices keep industrial costs manageable. Low volatility keeps paper markets credible. Depressed miner valuations create cheap acquisition opportunities. Easy shorting opportunities create profit for funds. Cheap capital for financiers creates influence. None of that requires a secret meeting. It only requires incentives. Now let's bring it back to what you should do with this information as a viewer. Because I never want you to watch content like this and feel powerless. The goal is not to panic. The goal is not to blindly buy anything. The goal is to stop being confused when you see the silver up, miners down day. When you understand the machinery, you stop taking it personally. You stop making emotional decisions at the worst time. If tomorrow you see silver making a sharp move and miners still lagging, it might mean the market is still in disbelief. If tomorrow you see silver hold a key level and miners finally wake up with volume, that might be the market starting to price a stronger phase. If tomorrow you see physical signals like Shanghai premiums staying elevated while paper price hesitates, that's pressure building under the surface. And one more thing, because this is the part that keeps people watching beyond the first few minutes. Suppression doesn't last forever, but it also doesn't end politely. When it ends, it usually ends with a repricing event. That repricing event can be triggered by sustained physical tightness, a sudden macro shock, a policy change, or simply a technical breakout that forces shorts and algorithms to chase. You don't need to predict the exact day. You just need to recognize the conditions that make a sudden move possible. So here's my question for you, and I really want you to answer in the comments because it helps the community compare real-world signals. Are you seeing high premiums or low availability for physical silver where you live in the US? And do you think silver miners are being held down mostly by the market structure and dilution? Or do you believe something bigger is happening with price control? Tell me what you're watching tomorrow. And if you want, drop the ticker of one miner you're tracking so we can all compare notes. And if this video gave you clarity, please share it with one friend who follows silver but keeps asking, why are miners not moving? Sharing helps this reach the exact people who need the explanation before the next big move turns into a confusing headline. Stay calm, stay curious, and watch the relationships, not just the price. Because when you understand why miners get suppressed, you also understand what it looks like when that suppression starts to fail.